Everyone asks the same question. Is the market going up or down?
But professionals don't trade direction. They trade volatility.
When we think about investing, most of us are trained to ask one question. Is the market going up or down? But what if there's another game to play? Today, we're going to look past simple stock picking and dive into how some of the pros trade the market's mood itself. All right, so here's our roadmap. We're going to start with what market bumpiness even is. Then, we'll uncover this really fascinating glitch in the market. We'll look at a simple way you could trade it, but you're going to want to stick around, because the real secret sauce is what a major university study found about the strategies that really work.
Okay, first things first. Before we get into any complex strategies, we've got to get our heads around the basic idea here. And that means we need to shift our thinking away from just betting on up or down.
Just think about that for a second. What if you could make money not based on whether stocks finish higher or lower, but on just how wild the ride is along the way? That's the whole idea behind trading volatility. It's a total perspective shift from predicting where the market's going to predicting how much turbulence there'll be on the flight.
And let's be super clear here. We're not talking about gains or losses. We're talking about the size of the moves. A market can be super volatile and end up right where it started. Think of it like a car's engine. We're not measuring the car's speed, we're measuring how high the RPMs are revving.
So the big question is, why is this even a thing? Why does this opportunity exist? Well, it's not random. It's all because of something called the volatility premium. And honestly, the best way to understand it is to think about insurance.
We all get how car insurance works, right? You pay a small, steady amount of money every month to protect yourself from the huge, catastrophic cost of a major crash. Well, in the financial markets, big investors do the exact same thing. They are more than willing to pay a small, consistent price to protect their giant portfolios from a sudden market meltdown.
And this quote, man, it just nails it. There's this constant, built-in demand for portfolio insurance. And just like with anything, high demand pushes up the price. The price of that insurance is what traders call implied volatility. It's the market's guess about future bumpiness. And the key is that guess is almost always higher than the realized volatility, the bumpiness that actually happened.
So that gap, that difference between what the market thinks will happen and what actually happens, that's the golden ticket. That's the volatility risk premium. The whole strategy, then, is to become the insurance company. You systematically sell that overpriced insurance and just collect the premium day in and day out.
Okay, that all sounds great in theory, but how do you actually do it? Let's look at one of the most popular, most straightforward ways investors can step in and act like that insurance company.
Okay, let's break this down. It's actually pretty simple. First, you start with shares you already own, say in an S&P 500 index fund. Then you sell something called a call option. This is basically a contract where you agree to sell your shares if the price jumps up to a certain higher level. And here's the kicker. For making that promise, for basically capping your potential home run upside, you get paid cash, right here, right now. That cash payment is you collecting that overpriced volatility premium we were just talking about. It's a way to generate extra income on a portfolio you already hold.
But, just because something's simple doesn't mean it's the best way. So which strategies really truly work the most effectively? Well, let's move from the simple stuff to what some serious number crunching from a major university study uncovered.
So these folks over at Monash University, they didn't just throw darts at a board. They went deep, analyzing a huge pile of S&P 500 options data to figure out which specific strategies, from the simple to the complex, gave the best, most consistent returns for the amount of risk taken. And this was a really smart move. They decided to focus their analysis on the years after the 2008 financial crisis. By cutting out that historic once-in-a-generation meltdown, they could really zero in on strategies that work under more normal, everyday market conditions, which is, most of the time.
All right, so what did they find after digging through all that data? Well, the results were, honestly, pretty eye-opening. They didn't just confirm that selling volatility works. They pinpointed very specific types of strategies and timeframes that consistently hit the sweet spot. Okay, check this out, because this is where the magic happens. The study showed that, yeah, simple strategies work okay, but the more sophisticated stuff, that's where the real outperformance was. Take a look at calendar spreads. That's where you sell a short-term option to collect that fat premium, but you also buy a longer-term one as a hedge. It lets you really isolate the part of the premium that comes from time decay.
Even better were these Vega-adjusted spreads. Basically, they're designed to make money from the premium itself without getting wrecked if overall volatility suddenly spikes or collapses. These generated some seriously high alpha. That's finance speak for returns that you can't just chalk up to the market going up.
And get this, they even figured out the perfect timing. The data was crystal clear. The best and most consistent returns came from using options that expire somewhere between 2 and 6 months out. Going too short or too long just wasn't as effective.
And this chart just makes it so obvious, right? You can literally see the performance jump. Look at the risk-adjusted returns. As the strategies get more advanced, moving from just selling a single option to these more cleverly constructed calendar spreads, the results in the study got significantly better.
All right, let's zoom out for a second. Let's pull all these pieces together. What's the big takeaway here? What does this actually mean for anyone trying to understand how markets really work today?
So to wrap it all up, what we've seen is that there's this real, persistent anomaly baked into the market, and it's all driven by fear, by big investors wanting protection. Simple strategies can tap into this, sure, but the huge revelation from the Monash study is that how you do it matters a lot. The data is pretty clear that smarter, more structured approaches, especially ones that play with different time horizons like those calendar spreads, have historically been the sharpest tools for the job.
And that really brings us to the million-dollar question, doesn't it? The whole idea here is to collect a lot of small, frequent payments. But the risk, the big, scary monster under the bed, is that you could suffer a huge, sudden loss if volatility just explodes out of nowhere. So, is this a truly sophisticated edge for smart investors, or is it just a fancy, high-tech way of picking up pennies in front of a steamroller? The data suggests there's a real edge to be had, but the risk of getting flattened, as always, is very, very real.